Hello, and thanks for joining us today. I'm super excited you could be here. Look, today we're talking about real estate financing. Look, the hardest part about investing in real estate and buying real estate is being able to get the actual financing for the real estate. This is something that so many of our tribes struggle with. And today we are going to solve that problem. So with us is a foremost expert on the topic, Martin Chera. Now, Martin's actually the president of Express Capital Financing, where they basically help business owners secure strategic financing solutions that are really tailored to their operational and growth needs. So his experience spans working capital solutions, equipment financing, and alternative lending programs that are designed to help companies access capital quickly and efficiently. So he's got a very strong understanding of small business funding and the landscape itself. Martin actually brings a practical, relationship-driven approach to helping entrepreneurs navigate financing challenges and identify the right funding strategies for their businesses. So Martin's perspective would be especially valuable for everything to do with financing in general, especially real estate financing, alternative lending, business financial strategies, access to capital, and he knows a lot about helping entrepreneurs better position themselves for funding opportunities in today's market, which is what we love because we're all about funding readiness. So Martin, what's going on, man? Thanks for joining me today.
Yeah, thank you. My pleasure as well, Ty. Thank you for having me on the team.
Yeah, I'm excited you could be here. So Express Capital Financing, you guys do a lot. Give me an idea of the general overall types of financing that you focus on.
Yeah, sure. So we're 13 years young, father and a two-son team. We strategically only do real estate financing. I started out as a loan broker, doing anything from equipment financing, merchant cash advance, equipment, SBA, and all that. And I found my niche in the real estate world, got excited about it, love it, been in real estate my whole life. So we only work with investors, landlords, developers, whether they're looking for a bridge financing, which is short term to buy a property, fix it up, and either sell it or keep it for the long term cash flow. So we do short term financing, which is a hard money bridge, DSCR, which is a 30-year perm, and then again for landlords, investors, or developers, we do ground up construction, whether it's a 1-to-4 multifamily or mixed use. So that's our niche, everyday product.
Okay, cool. So several different things I want to dive into because you handle everything to do with, it sounds like, the residential side. So first of all, you're dealing a lot with everything you do is residential, correct?
Residential, multi, mixed use, and we do commercial properties as well too. But it's only geared to properties, real estate.
Okay, to real estate. So let's talk a little about what I call fix and flip financing. You might call it something differently. So then the biggest problem that I find is that a lot of people struggle to be able to get the financing they need to be able to jump in and start fixing and flipping properties. So give me an idea. How is it that you actually move forward and help a business owner or help somebody that's looking to get into real estate investing or already is get into getting the money they need to be able to buy the property and to be able to rehab the property?
Yeah, so coming in 13 years ago, there was only a handful of lenders out there, and it was difficult to get the financing, whether it was credit, low LTVs, many issues from, 2014, 2015, taken now to 2026. The lending has opened up tremendously. A lot more lenders on the platform, a lot of institutional capital out there. So whether the investor is brand new or savvy, the capital is there, but it is all about the project. That's what a fix and a flip or hard money or asset-based loan is about. It's all about the project. Capital is there, new experience, and even if your credit is somewhat weakened, we could work with that borrower or go to your platform and, get that better credit to get a better terms with the lender, but that's what we do.
So you're working with somebody with even average credit to be able, new or experienced, to be able to get in. So what does that look like? Like if I'm looking to buy a property, what are the primary things that you're focused on from me as the borrower that I should know that you're really looking for to be able to qualify for fix and flip financing?
Yeah, great question, Ty. Great question. So it's all about the asset. That's why really it's called an asset-based lending. We're looking at the purchase price today. We're looking at how much the borrower is going to spend on the property, which is the rehab component. But more importantly, we're looking at the exit. The exit's going to be one of two things. Either they're going to sell it for the flip profit, or they're going to keep it for the cash flow and become a landlord. And we're also looking at that too. So we look at the ARV, which is called after repair value, if they're going to sell it. If the buyer is buying it for 100 and the rehab component is 50,000, that project cost is 150. Assuming they tell us 250 is the ARV, it sounds like it's 100,000 gross profit. At the end of the day, after paying for the closing costs, title, insurance, lawyer, origination fee, the carrying cost every month on the property, that 100 gross probably becomes 50, 60, 70,000 net profit. So we're looking to make sure two things. On the flip side, like I said, that exit, that's one of them. We're looking at the profits and we're looking at the return on the investment. If it's more than 20,000 profit or 15% profit, we are happy and will continue to fund the deal. That's why it's strictly an asset base. It's not credit base. It's not liquidity, net worth base whatsoever. If the borrower is going to keep the property after they're fixing it for a 30-year DSCR for the cash flow and keeping the property and having growing their portfolio, as a lender, we're stress testing it by looking at what would be the fair market rent, taxes, insurance to make sure that it debt services for the future mortgage payment. Again, unlike a bank where they're looking for the tax returns on the borrower, tax returns on the company, which is the property, profit, losses, all that kind of stuff. As a non-bank private lender, on the permanent side, it's all about the cash flow, which is the debt service coverage ratio. If it covers, if it's more than 1.0, what that means, Ty, is that the rent is covering the mortgage at a zero cash flow, it's fine. So asset based only, flip profit 15%, 20 grand, or the exit would be they're going to keep it for the cash flow.
I love it. And like you said, it's way easier. If we look at, traditional bank lending, the problem is, as you said, the individual has to qualify through all these things: personal, financials, credit. The business has to qualify, oftentimes business credit, financials, all these things. And what you're doing is just what I call common sense lending. You're just focusing on what's most important, which is just the asset. Like if you've got the right property and, for example, you're fixing and flipping it, then are you going to make a profit? Like if the basic question is yes, at a reasonable amount, what you're saying of 15%, that's something that you're interested in. So do you talk about it being bridge financing? What kind of term, how long are your actual loans? Because it's designed to bridge the gap if they fix and flip before they're getting longer term financing. So how long does the term go up to?
Yeah, so the bridge product, which the other word for it is called hard money, fix and flip. There are many, terminology today. Typically 12 months, interest only, rates anywhere from 8 to 10% on an interest only loan. And the good thing about this product, it's very high leverage. Experience qualifies leverage. Experience qualifies leverage. Meaning great borrower is going to put down 10% on the purchase price. They're going to get 100% of the rehab or / CapEx, going to get 100% of it, and they're making all the profits. So this is the dynamics of real estate. If you have 100,000 cash on the deal, let's say the purchase price is 100 and you have that 100 liquid yourself and you're going to make 100,000 profit, well, your ROI is 100%. 100,000 cash, you're going to make 100,000, you made 100% return on the investment. If you take that same project and you leverage it with a lender, 10% down, which means $10,000, now your ROI became 1,000%. So what's better, 1,000% ROI or 100%? And that other 90,000 that you have in your pocket invested into diversifying it into other investment projects, portfolios, Bitcoin, stocks, bonds, other real estate. That's the way you grow wealth in real estate. So leverage is the key to success in most businesses and especially real estate.
Wow, I love that. And I could say 12 months is long term. Like usually bridge loans and fix and flip, the people that I know of that are in that space, 6 months seems to be common. So I love that you give them so long to bridge that gap of up to 12 months. The rates are low. Considering it's hard money in a lot of cases, that's like really low rates as well. And interest only keeps the payments low. So you're saying that somebody can get into the property for like as little as like 10% down of whatever the purchase price may be?
That's it. 10, 20% down, they're in. And going back to that 12 months interest only, there's no prepayment penalty. So if the project takes them 4 months, they're just paying 4 months of interest. 5 months, 5 months of interest. There's no penalty whatsoever. They're only paying for what they use. So obtaining high leverage, low rate, no prepayment penalties, it's a very good product, and no bank is doing it, providing these leverages, rates, and terms today for investors to grow their wealth in real estate. It's a great tool.
Yeah, I love it. And this is just one. We're going to talk about several of the instruments that you actually have, several of the different products that you have. But if I'm coming to you as a borrower, like what do I need? What do I need to make your job easy? What do you need from me? Or what would you like to see to have an idea that I know what I'm talking about and that I found the right property that I think you're really going to like? Like, what do you want to see me come to the table with being preparedness wise?
Knowledge, knowledge, knowledge. Yeah, it's a great question, Ty. Really just a few numbers, which would be the purchase price, the rehab amount, the after repair value, your credit score, the address of the property. Because we look at the address on Google. We want to make sure that the property area is liquid. The properties are buying, properties are selling. Don't give me an area where there's 100 properties and there's only one sold in the past 12 months. There's not a lot of liquidity. We want to see action in the area. We want to see that it's a rental market, it's a sale market, and as well as the after repair value is going to be there. Because it's a very important component. Why would somebody buy it, fix it up for that 50,000 rehab if you're not going to get to that after repair value or your rent to keep it for the 30 year. So it's a very light doc, and I want to add to it that the time to close 1 to 2 weeks. So the borrowers just have to give us just some numbers: purchase, rehab, after repair value, what's your exit, your credit score, and tell me your experience. You've done one deal in the past 5 years, 5 deals in the past 5 years, because experience provides leverage.
Yeah, I love that. And 1 to 2 weeks, you're talking about basically the same as a cash transaction. So you talk about leverage, like that gives me leverage in the deal because I'm able to go into whoever it is I'm buying from and close in the same amount of time as somebody thinks literally paying cash for the property. So that gives me a huge advantage to be able to actually get and close the right deal when I find it as well.
That's exactly it.
Yeah. And it sounds like your team is proficient to help. I mean, you're not here to educate, me as a rookie through it, but properties inside and out. So if there's things I'm missing, then it sounds like your team's going to be the one that alerts me if that's the case, if I'm coming to you with the things that you mentioned.
100%. We're kind of doing a soft underwrite from day one. We want to make sure that even if we're providing you terms on the first phone call, that we're going to be able to fund it and it's a good deal. We educate our borrowers sometimes why it's not a good deal. Whether, like I mentioned, liquidity. One time I had a borrower who was buying it and keeping it for long term for the rental cash flow. And when my team found out there was going to be a warehouse opening up right across the street from the borrower's property in a year from now, I says, look, your projected rent is going to be 2,500. Who's going to pay 2,500 a tenant, knowing that there's 10, 20 trucks moving in and out every day across the street from their property? He didn't know that. And that's where a good lender comes in, doing a market analysis, looking at everything on the area to make sure that it's a good deal for the borrower and let even us ourselves to lend on.
Yeah, it sounds like a great partnership. What if I know what I'm doing, I'm experienced, I've got the cash, and I happen to find 2 properties that I want to buy or 3 properties that I want to buy? Are you able to help me in those scenarios as well?
You could do as many as you want as long as you got your 10% down. Yes, you could do 3 simultaneously, 30 simultaneously. No concerns with that. And we'll even help the borrowers who are lacking liquidity, where sometimes we will come up with the equity ourselves, or we'll find you a partner that maybe has the experience or has the cash available that wants to invest into something.
So it really comes down to if I find the right property and really the right deal, then it's worth coming to you guys and having a conversation about.
Most definitely, yes. Because
So
we're
are
not
you
educated on the lending, we're educated to help the borrowers to execute the deal.
are you all over the country?
Nationwide, yes.
So you're nationwide.
Yes.
Okay, so I love it. I love everything you've said about fix and flip. It makes a lot of sense. And something you said that we've mentioned a few times along the way is DSCR. Now, there's people watching here that don't know what DSCR is. I think it's like the greatest thing ever when it comes to real estate. But if you could give us an idea, like how does a DSCR loan work? What is it? How's it work?
Sure, great question. I appreciate that too. So it's only I think about 6 or 8 years young, and it's come to fruition in the past 3 to 4 out of that 8, coming very, very strongly. A lot of lenders only did hard money fix and flip bridge when I first started. Now in the past 14 years, DSCR is taking over a large percentage of the business because the flip side of the properties the profits unfortunately have tightened. Cost of goods are more expensive, buying houses are more expensive, rates are elevated, so the profits have decreased immensely. Average, nationwide used to be around 80 to $100,000 typical flip profit. Now it's tightened so much to like anywhere from like 40 to $60,000. DSCR has grown dramatically in the past few years. It stands for debt service coverage ratio. Again, no tax returns, no W-2s, no income verification. Very similar to an asset-based lending, and it is an asset-based type of structure where we're looking at the property income, which is the rent, making sure that the rental income can cover the debt service, which is the principal, interest, taxes, and insurance, the petty payment. Most lenders, like me, will work with a 1.0 debt service. What that means is if the rental coming in is 2,000, and if the mortgage payment is 2,000, it's zero cash flow, but it covers the debt service. It's fine. Okay. I mean, as a lender, I can go 0.75, meaning the property could be negative 25%. I would still fund it. I'm one of the few that does that. But just to give you some parameters for your audience about what this debt service means, light doc, closing time 3 to 4 weeks. It's all about the income of the property and the expenses of the property, and that's it. Most DSCR lenders are credit sensitive, like me. Anywhere, I mean, I could go as low as 600, but I'd like to be at a 660 or above.
Okay, perfect. So that's way low. So you're talking about say that credit score for me again. You can go as low as 660, but say that for me one more time.
Yeah, sure. So I can go as low as 600. However, we'd like to be at a 660 to get a normal rate.
I had to stop there for a second because that's exactly the opposite of what I understand for DSCR. Like, I always honestly thought DSCR in the industry wide was for those that had good credit. Like, the people that I talk to usually in that space are 680, 700 minimal score to even consider DSCR. So you're saying you go down to a 600 FICO with DSCR and you prefer 660 plus. But I mean, that could be, from what I know of, like some of the lowest qualification criteria in the industry.
It is, but again, there's factors that go into a low score. They're going to get a lower leverage and a higher rate. But if they want the normal today rates and the normal today leverage, and let's just talk about leverage on the product, we can go up to 85% on a SFR, which is a single family rental. And otherwise 80% on a 2 to 4 unit, 75% leverage on a cash out, whether it's a rate and term or cash out. So typical terms, 85 on a purchase, 75% on a refi. Scores, again, 660 would put them in that 6% rate approximate. But if they're in the 600s, they're just going to be a slightly higher rate and lower leverage.
Yeah. Oh, makes sense. I mean, ultimately, and it's something I reiterate all the time, what makes the score, right? I mean, if you're late on a bunch of stuff and you're defaulting on stuff, you're going to have a problem getting financing. But if it's things that, really still don't adversely affect your ability or look like it adversely affects your ability to be able to pay back the debt, well, then you got a better shot. So I absolutely love that. So you're talking about going as high as 75% on a refi, on a cash out refi, and then 85% on a purchase.
Right.
Okay, so I mean, DSCR, just great way to go. For me personally, I love it because I'm self-employed, right? So and part of my money is W-2, part of my money is not. So DSCR makes a lot of sense because a lot of people getting into real estate, they're already in it. They have a hard time verifying income. And I think that's where they get stopped at banks. But it sounds like now you're talking about another really common sense way to buy a property that you're not going to flip, but one that you're actually going to buy and keep a hold of for long-term or short-term renter to put somebody in the property.
Exactly. And it's great for investors. Of course, you hit the spot. Banks are decreasing leverage. They want to see tax returns. If your income does not substantiate it, they're not going to fund you. Where DSCR, you have no worries. Every investor, their goal is and should be, I want to grow my wealth in real estate. Okay, so banks may be in the 6s, DSCR may be in the 7s, 100 basis points more, but it's all about the goal. What are you getting to? Increasing your wealth, having a portfolio of real estate. That's what it's all about.
Yeah, and I love it. And Martin, I mean, it sounds like you guys have a lot of different solutions depending on what somebody's looking to do. I'm just curious. With the DSCRs, are you starting to see, how do you see with short-term rentals like Airbnb and long-term rentals? What do you see in the market? Like what are more people doing one versus the other? Are you seeing one grow faster than the other?
So Airbnbs, we do a little bit of it. We don't get a lot of calls with it. There are some restrictions that go involved with it, but every day 1 to 4s, long-term rentals is the main flow that's coming into, my business at least. I can't talk about others.
Right. Okay. And I appreciate that too, because I think we here, it depends on the area that you're in. Some areas in New York, New Jersey, it's harder to get into short-term rentals. In other areas, it's easier in different cities and
It's
states. Okay.
it's
So,
it's it's
any other thoughts on DSCR that somebody should know? Like, what should I have prepared to come to you to make it your process easy to be able to get approved for a DSCR loan?
it's just all about the numbers. Have a conversation with me or my loan officers. Just give us the purchase price, your score. We will, tell you what your rates will be. But when it comes to rates, it's all about score, leverage, and now DSCR has a prepayment penalty component. With me, I mean, typical terms on a DSCR are what's called a 5-year step down prepay, meaning it's 5% the first year. It's a 5, 4, 3, 2, 1. The next 25 years, no prepay whatsoever. That's typical terms, and that's what I have, and most lenders have. Other lenders also have a 3-2-1, which is called a 3-year step down. The next 27 years, no prepay. I have many more prepay options. I even have a zero prepay. So it's all about what the investor or the landlord wants. If they're going to tell me, Marty, I'm only going to keep the property for 12 to 24 months. I'm selling it. I'm refinancing it. Well, you know what? Pay a slightly higher rate and have a zero prepay. Why would I want to have a 5% on $1 million or $50,000 hit in the first year or two when I'm going to sell it or refi? I'd rather pay from 7% to 7.5% with a zero prepay or one prepay versus a 5-year or 3-year. So I always like to identify what the borrowers want. I should say more what they need than what they want, because everybody wants the lowest rate, the lowest fees, but I like to identify what they need to get them where they want to be at.
Yeah. Once again, what I just call common sense lending. Like you're working in this scenario, working with your end customer, figuring out what works for them. And then you have a plethora of options based on what it is that their short and long term goal is and what they're trying to accomplish that helps them in that scenario.
Yep.
DSCR portfolio loans. Can you talk to me a little bit more about those?
So portfolio is just another word for it is a blanket loan. It just means many properties under the DSCR. So instead of having, if you have a portfolio of 20 properties, instead of doing 20 separate properties, it's going to be one payment, one underwriting, one payment. That's all it really means. It's a positive for the borrower where it's one payment, one underwriting. It's a negative for them also because sometimes out of that 20 properties in your project, some of them have a low debt service because the income is low or the expenses of taxes and insurance are high, and that minority could hurt the majority. So, once you're talking to a lender, we will guide you and tell you it's better rate, better leverage if you do 20 separate properties or if we do it all as a blanket/portfolio. But that's all that it means.
Does it make sense to come to you if I have many different real estate loans now? I own a bunch of different properties. I got individual loans on each one of them. Does it make sense to come to you and have a conversation then to talk about a blanket loan or a DSCR a portfolio loan at that point?
Yeah, I mean, if you're looking to either purchase or cash out, by all means, yeah.
Now, another thing I want to talk to you about is ground up construction. A buddy of mine, Dan, here locally, it was a really successful business. Then he gets into real estate and he starts building. Now he builds these houses from the ground up, puts them into long-term, short-term rentals. I mean, crushes it. I mean, just absolutely crushes it. Like 2 years later, he sold his business. He's retired and travels the world. I mean, like he's just killing it. But I don't see a lot of people out there doing these kind of ground up construction. So what do you do when it comes to ground up construction financing for real estate?
So our platform used to be just 1 to 4 ground up, and I'm happy to say in the past 24 months, we've expanded it to multifamily, meaning 5 to 100 doors. And we expanded it also to a mixed use where there's a commercial component on the bottom and residential on top. It is, it's a small percentage of our business. It's growing. The reason why, that side of our business is growing is because there's not a lot of inventory of existing properties, out there. So when that's happening, investors are deciding, let me buy a piece of land, let me just build it. Unfortunately, there's a lot of concerns and delays that are happening and causing these investors to think twice and sometimes three times about doing a ground up, whether it's time to get permits, whether it's, constraints on the construction side, labor, materials, and again, the carrying cost of, of the financing, the monthly expenses, the taxes, the insurance on the property, getting the construction crew to commit to a timeline frame to finish. So especially in the East Coast, it's a constraint with the weather conditions, but they're still doing it. The smart investors are still doing it. And by the way, the ground up is the most riskiest type a lender could do because we have to look at it, of course, experience on the borrower, the credit on the borrower, but we have to look at it in my eyes, in a lender's eyes, what happens if we have to foreclose on the property? That's why I go back to that ARV. Is there room over there for a profit or just to get back my money and exit out of the deal if I'm taking it over? So in a ground up construction, we have to look at it from what happens if the borrower hasn't even started construction or if he's mid construction and the deal goes sour, we have to take it over. So it's very risky. The rates are, a little bit more higher than the normal fix and a flip to mitigate that risk. But just to let you know, that's what it's all about. But the smart investors, they're still doing it. I got some great investors who are pounding it away on the ground, on the ground up, even though their profits are constrained somewhat. So it sounds unfortunate to them, but they're realizing it. Let me do more because there's less inventory out there. And by the way, buyers, which that's the end result. They want to sell to homeowners when there's a lack of inventory. Now they're going to go to the new properties where they see the value in a new kitchen in a brand new home versus spending that same dollar amount on a 30, 40, 50-year home also. So that's a good thing also for ground up construction developers.
I love it. All right, so Martin, let me ask you this. If I'm interested in, I've got real estate, I'm interested in getting into real estate financing. I'm already in real estate financing. I own properties, and there's so many different scenarios. If I want to get in touch with you to just see what you can do to help me in my scenario, what steps should I take? Where should I go to be able to learn more and reach out to you and your team?
Appreciate that. Yeah, so my company website is expresscapitalfinancing.com. My personal office number is 201-603-2370. And if they want the company line, it's 718-285-0806. Just press sales and any loan officer will pick up. Our loan officers, they're here to be not just giving them the best terms. We pride ourselves, and I forgot to mention this is something that's important for our investors to realize, our clients to realize. We're number 3 on Forbes, 3 years in a row. Very hard milestone to reach because we pride ourselves on service, communication, certainty of execution to close. So don't just come to us for the financing, excuse me, come to us for the ideas, the concepts, the thoughts, and don't be insulted if we say we don't like it. Sometimes we'll still lend you, but we don't like the deal. We'll always give the reasons why.
I love it. Thank you so much for coming on with us today.
You got it. You got it.
All right, listen, if you're watching this, you're even thinking about getting into real estate financing, or you already are, you really should reach out and go to expresscapitalfinancing.com because as you've seen, they have by the way, we just scratched the surface. They have a lot of other different types of financing that they even have on the commercial loan side, the mixed use property, the residential side that we didn't even get to talk into about today because there's so much that we just try to cram as little as we could into the 30 minutes of time that we have. You're talking about best hard money lender in Forbes for 2-3 years running, 24, 25, 26, not 3 years ago, 10 years ago. This is recent. I mean, they are the source when it comes to bridging this gap for fix and flip, for DSCR, for ground up construction, amongst many others. And what I love about this is that if you're a real estate investor, they're like your final check as well. They can tell you, hey, what you're doing makes sense. What you're doing doesn't make sense. Things you need to consider. Things that you have a blind spot to, they see because they see these deals all the time. They funded over $1 billion, $1 billion plus in financing. They've helped thousands and thousands of clients be able to successfully come in, refinance, build, purchase real estate, including short-term, long-term, including bridge financing with fix and flip all the way to DSCR and much, much, much more. So go to expresscapitalfinancing.com. When you're at expresscapitalfinancing.com, there's really two options you should take. One is apply now. You can apply now and see exactly where you are with the property you're looking at. You can also see their loan programs right in the center of the page. So you can click see the loan programs and see the details about the financing they offer. While you're there, then go to the bottom left of the website. The bottom left of the website is their phone number, which he just gave you. But if you forgot it and didn't write it down, it's right there. And then also their social media pages are there. So see what they got going on. Like follow them on social. It takes less than a minute. And then that way you can be in the know when things are changing in the lending landscape when it comes to real estate financing. So make sure you check it all out, expresscapitalfinancing.com. Thank you very much for tuning in. Take care and have a great day.
Thank you. Thank you. Likewise. Thank you, Ty.